Good evening, everybody, and welcome to the Hump Day Market Update. I am your I am your host, and you hear my co-host laughing. I'm going to go to the wide screen there.
Look at this glittering dress.
That dress is unbelievable.
It's on fire.
Is that your Halloween costume?
It is, yes. Just getting in the spirit a little early.
Nikki's wearing the glittery dress tonight, so she did this purposely.
Yeah.
Because this is an important day. This is the day before the all-important CPI number comes out.
This is my morning attire.
It's your morning attire?
It is.
Although we are doing this live at 7 p.m. on Wednesday, hence the term Hump Day.
Hump Day?
October 12th. So this is your morning attire?
No, morning as in M-O-U-R.
Oh, morning.
Yes.
Okay. It's like I have a couple options for names to my boat. And one of them is Morning Wood, which is M-O-U-R-N-I-N-G. And you could do W-O-U-L-D.
Oh, there you go.
Yeah. So anyway, hey, welcome to the show. We're going to go over a lot of things tonight. We're going to talk about. I know people are nervous. All right, we're gonna just address the pink elephant in the room, and it's a pink elephant because it's more than just a regular elephant. People are scared and they're concerned, and they have good reason to be. But I just want to remind everybody that history tells us that markets go up, they correct, and they go up again, and they hit new highs. I'm not saying they can hit new highs. I say based on history, they have always. That's one thing I can say is based on history. Before the last 2 years, let's call it, the market has always hit a new high. In fact, on January 3rd this year, we hit a new all-time high in the S&P 500, and it will happen again. It's that these times are part of that economic cycle that is painful, and the Fed is certainly on a mission right now because they were dead wrong in the last year. Nick, you follow the Fed quite closely.
We have experienced the pendulum swing from one side where the Fed was so obviously wrong about transitory. It's now that pendulum has swung completely the other way, where I fear that they are too fearful of not doing enough, that they're over punishing the economy for past mistakes of the Fed and not letting the rate hikes that they've already done play out. And so then you've got a market that's just anxiously sitting there waiting for them to pivot. That shouldn't be the case. It shouldn't go from quantitative tightening to quantitative easing.
These words, now at least pivot is a common word, but transitory is not a common word. That was their word.
We didn't even know what it meant when we were saying it.
We kind of knew transitory is temporary.
Right.
Or short term. But a pivot, which would mean that they are changing course.
Right.
And I don't think they're changing course anytime soon. However, I'll say this. I think that the Fed is going to raise rates November 1st and 2nd is their next meeting. They're going to raise rates. There's a 90% chance based on the Fed funds futures, 80 to 90, that they'll raise 75 basis points. Your dress is distracting, by the way, the glittery. So what that means is, first of all, the Fed's target, I believe, is a 4.5 or 4.6 Fed funds.
Which is just astronomical. We started the year at zero.
So let me just share this with you. We started at 0 to 25 basis points because it trades in a range, okay? We are now at 3 to 3.25. In 2 weeks, almost 2 weeks, the Fed's going to likely raise 75 basis points. That puts us at 3.75 to 4.
It's also the fourth consecutive 75 basis point rate hike,
which has never happened.
And it takes a long time to see the ramifications play out broadly through the economy, through the supply chain, and have an effect on inflation. And we're doing it at such a rapid clip that we aren't seeing what it's doing until we're too far gone.
Well, we are seeing what it's doing to the stock market immediately. The stock market has not been doing well. Although last week, believe it or not, it didn't feel like it, but last week was an up week. We were up at 1.5% on the S&P 500, but it felt like it was a miserable down week because
Wednesday, Tuesday felt great.
Monday, Tuesday up 6%. Wednesday, Thursday, Friday, we were down 3.5%, 4%.
And I mean, I hate to add more negativity to the conversation, but two of the
Please do, because I want to talk about
I'm
negativity.
Negative Nick here. Two of the S&P 500's 9 largest down days have come on a day when CPI data was released this year.
Okay, so
and that's tomorrow.
So the CPI, it's an acronym for the Consumer Price Index. Basically, is the rate of inflation.
Yeah, it's the basket of goods and services that we, the consumers, pay.
So last month, first of all, the month before that, we were over 9%.
Yes.
Last month, it was
8.3.
Tomorrow, the expectation is
They
lower.
are saying 8.1%.
Okay.
If we saw a 7 handle, though,
If we see a 7 handle, meaning something at 7.99,
it would really prove that what the Fed is doing is causing enough demand destruction to cool inflation.
I did a little experiment last night, and because my wife is a realtor, and she thinks that Zillow is enormously inaccurate in their, and they are, because they don't know what you have inside your house, they don't know the upgrades.
It's a guesstimate.
It's a guess, and actually, the Zillow CEO came out and said we're within 10%, one way or the other. Okay, so let's just say that. So I'm not going to tell you the value of my house, because I know all you psychopaths out there can go look me up and see what the value of my house is. But I'm going to tell you that I saw, just for shits and giggles, I looked at my house like 3 months ago when things were really, really great and the market was crazy. And my home is now down about 2-3% from I looked last night, which is not a big deal. It's 2-3%. Stock market's down way more than that. So,
and your average 30-year mortgage is now 6.85%.
That'll put a damper on it.
Yeah.
Okay, that'll put a damper on it, because now you're going to have to buy down rates. So let's say, and this is, look, I'm not a mortgage expert, but I was talking to somebody who's a home builder today, this afternoon, and he said he's got a guy looking to buy one of his homes that he built, and he said, I'm willing to give them $10,000. They could buy down the rate or whatever. And he said, so I said, so what buys down the rate a point? He said 1% of the value of the home. So again, I can't verify this. I'm just mentioning it because I think it's probably right. So if you have a $700,000 home, that your sales price, you want to go out and you want to lower that rate, he says $7,000. It's going to cost you to lower it a point. Again, I don't know if that's accurate. I'm just going by what he said. My point is, there's incentives out there. He's a builder. Mm-hmm. That's my point. There's incentives because they realize that a lot of people that qualified for this house 9 months ago, when rates were 3.5%, now may have a problem at 6.85, by the way, which is the average 30-year mortgage.
It's insane. I mean, mortgage applications are down, 2% for the week and 39% lower than a year ago.
And refis are down 80.
Okay, so at this rate level, there are only 150,000 borrowers who could benefit from a refi.
That number was 100. It was 450.
Yep.
Are you kidding me?
Nope. That is as of this morning. And adjustable rate mortgages are out of control.
This is all right. Think about this. And I think this is a really big stat because a lot of people use the equity in their home with a refi. And we used to call this the ATM because people would say, "Oh, I want to, put a pool in. I want to buy a boat. I want to pay off my cars." They grab off their ATM, which is that they just refi their house. Not long ago, it was 450,000 because we talked about it. Mm-hmm. And I like to break things down to the ridiculous. So what that meant was, and I know every state is larger. We know that Florida, California, New York have the most mortgages. But 3 months ago, it was 450,000 people could benefit from a refi in their house.
At the rates where they were at.
At the rates where they were at. And I said, okay, so let's divide that by 50 states. Mm-hmm. So that really means that 9,000 borrowers in each state can qualify for or would benefit from a refi. Right.
Now it's even.
So you said 150.
150,000.
Okay, divide that by 50 states. That's 3,000 borrowers
per state.
And unfortunately, not unfortunately.
But it's not even really per state because, 1,000 people a day are moving to Texas. So
no, I got it. But my point, I'm just trying to break it down. Ridiculous.
Yeah.
We know that.
Come on, think about that.
We know that Texas, Florida, California, New York are getting a lot of mortgages. Mm-hmm. But if you're a mortgage broker in Delaware, there's like 200 people with hundreds of mortgage brokers in Delaware. So my point is, and we have friends and we have clients that are mortgage brokers, and I feel terrible for them, but they did make their money.
Yeah.
It was easy money. Everybody was making easy money, and I get it, and I hope they can recover from this. And I know some guys that are they're really working hard, and the mortgage brokers are working hard, but they're going to have to at this point.
They're absolutely going to have to tighten their belts. However, something that I do really want to emphasize is that this is not the 07, 09 housing market.
It's not a housing crisis.
We're not seeing any of that. We're not seeing banks go under. This is not, it's not only Fed induced, but it's also the consequence and our actions catching up to us as far as what happened during the pandemic when we let fear over facts dictate how we moved forward in our economy.
I mean, I know we can always armchair quarterback.
Oh, without a doubt. Monday morning
quarterback. I mean, that's
My
really
rear
easy.
view mirror is just as
Yeah, your rear view mirror is great. Just as great as mine.
Yeah.
We can all look back and say, should we have done all of this? And
once in a lifetime pandemic. I mean, what are you going to do?
And nobody knew how to handle it.
No.
So you know what? You got to pay the price now. So we are paying the price. So let's talk about what the markets did today. And I will share that with you. Let's go to, okay, so I'm going to, right here. The Dow Jones, that's small print, isn't it?
Tiny.
Yeah, that's what she said. Anyway, the Dow Jones down only 28 today at 29,002. Come on.
Did you just make it bigger?
That's what she said. No, that would take time. 29,210. The S&P 500 down 11 at 3577. By the way, she's my daughter's best friend, okay? The NASDAQ down 9 at 10,417. Small caps, they were down a little bit, but nothing was down that big today. And, when you look at stocks across the board, didn't have a great day, but it wasn't a bad day either. And we had that day last week, the 2 days that really were exceptional. And I think that we really what I want to do is I just want to talk about facts of the market, because we do believe, I'm not going to speak for you. I've been doing this a long time, and I'm telling you right now, I think the market's going to rally between now, and I never said October it changes, middle of October. Middle of October is usually really bad. That's where we are right now.
October surprise.
And then you get the late October, early November rally. I do believe that the market will be, the S&P will be probably, I'm going to guess, I'm going to estimate, this is not a quote, it's my quote, but it's not a guarantee. I think the market will be up 10-15% from today's number. And I want you to write this down, Nikki.
I don't have a writing utensil here.
You don't have a writing implement? We have plenty of them.
Got it. Go ahead.
Okay, write that down. And when I get back to the other screen, I will, I'll do it right now. Okay, let's just go, because I'm going to find this. So the S&P is at 3577. I'm going to do the math. 3577, and I hope I'm right. I hope I'm wrong. I hope it's higher than that. So 3577 times 1.1. Let's do that. My minimum, that's 3934. So around 4,000.
All right, that's your prediction.
That's what I think. I do believe that we'll have a 10%. I truly want to say 15% rally, but I want to be more right than wrong. But I do think we could be. It wouldn't surprise me, a 15% rally. But I think a 10% rally, because any piece of any good news, there's been zero. Tell me one piece of good news, please. Tell me something. You have the hurricane in Florida, the glittery dress. That's great news. What else? Is there any good news out there? The Yankees won last night. Good news. Okay. Give me something else. The Patriots won.
As far as economically speaking, no, I cannot give you.
Not one bit. And so.
And also geopolitically, I can't give you any single bit of good news.
Speaking of geopolitically,
that has quite a bit of an effect on the supply chain.
And I think that the midterm elections are likely going to go the direction the market wants to see.
Gridlock, baby.
I believe that you will have the red side capture one of the branches of government, and then that is gridlock, and that's okay because the market's okay with that.
The market likes gridlock. The market doesn't love change.
No. And go ahead.
My opinion on what
Love to hear your
the
opinion.
year end is going to look like is that year-end rallies tend to be historically strong during midterm years. So I definitely think we're not going to end the year in the same predicament. I'm excited to go into a third year of a presidential cycle.
So do you think that same predicament? Please explain that.
I don't think the NASDAQ is going to be down 30% plus. I don't think.
Okay, so you're saying it's going to be up.
Right. Absolutely.
Okay.
From here, these levels.
Okay, well, yes, I agree, because we're down so far
Right.
that I don't believe we go down that much lower. We're closer to the end than the middle.
It's capitulation time. But no, actually, I do have a bit of good news.
Give me something,
Fixed
please.
income. We have never seen rates.
Thank you. Thank you, Nikki. I totally forgot about that.
It just never seemed relevant.
Oh, God, fixed income. Now, if you are a balanced account type investor, meaning balance is 60-40 or 50-50, meaning 60% equity, 50% fixed income, it has been absolutely shitty because bonds are down 15 to 20% across the board. Bonds, safe investments,
The safe haven.
safe investments are down. Yes, so let's talk about that. This is what we've done lately for some clients. We've gone out and bought 1-year treasuries.
I never, ever thought there was going to come a day where you were bullish about treasuries.
A 1-year treasury at 4% for your safe money.
A CD replacement with liquidity backed by the full faith and credit of the United States government. I'll take it.
That's not too shabby.
No.
And then we're looking at some of the insurance opportunities out there. There are annuities that are giving cap rates, meaning you have the potential to make 8 to 9 to 9.5. I saw some out there at 10%. If the market does that, you get 8, 9, 10%. If the market goes down, you get 0, so you don't go down. I mean, this is just absolute craziness.
Right. So that is definitely a positive that there are financial opportunities out there in what otherwise seems a pretty dismal environment.
So if you have cash on the sidelines, okay,
if anything is frozen in fear under your mattress, we can give you the 3 things that most people want when it comes to their cash.
What are those?
Yield, liquidity, and safety of principal.
Boom. That's a boom. That's a boom. Is that or? What's this one?
Just
You
don't
may
put on
want-
Katy Perry.
I'll do Katy Perry. I was going to do that. I was
please.
looking for it. That's great because we can get you liquidity. We can get you really, really good yield. So,
And safety of principal, so you don't have to worry about that being eroded, which
And-
is what people are really concerned about.
and we're going to get into the stock market. But you brought up fixed income. I also want to just mention something where I have been absolutely crushed by leasing warehouse space. I have leased warehouse spaces, parking spaces,
The parking space is really egregious
boat
to
storage.
me.
Yeah, it's funny. Real funny. Boat storage. And then I started thinking, these are got to be. And I knew that storage facilities traded and traded REITs. But then I started looking at opportunity. If you are an accredited investor, meaning you're worth $1 million or more, we need to talk because the storage type facility investments have yielded 3 and 5 year 18 and 14.7 respectively, and with an income unbelievable. So, and I know this because I rent a space between 2 lines for a trailer and I pay $160 a month. I rent a double storage unit and I pay $490 a month. I have boat storage and basically it's covered and it's a spot for $285 a month.
Well, it's a good thing. I mean, at least the storage unit's only going to be like 3 months, right?
Yeah, no, I've had it for like 8 years.
It
So
starts at 3 months, though.
listen, if you're looking for something that is an alternative to the stock, it's not correlated to the
Yes.
stock market, not correlated to the bond market. This is a great opportunity. When you get, call it 14 to 18% in a fairly conservative investment, this is something that's really incredible.
Not to mention, I mean, historically speaking, real estate is an excellent hedge against inflation. It's not sexy storage units. You know, it's what, three walls, a door, and a light bulb. A tenant leaves, you sweep it out, and then you slap a new lock on it. That's the maintenance.
And no, you don't slap a new lock.
Oh, is that the
tenant provides their own lock.
All right.
I provided many locks.
About that.
So, and here's what's interesting is because these guys, they go out and they acquire mom and pops. They go out and do find rundown ones and renovate them. But there's a great opportunity. I think that, and it's been the one of the top performing real estate investments in the last 20
the
years.
Sector specifically.
Yeah, it's been great.
People need storage units when they're decluttering, downsizing, death, and then there's one other one, and I can't remember it.
Dismemberment? Oh, I'm watching too much of that Dahmer thing.
I was like,
Okay,
is Breaking
sorry.
Bad?
Sorry. No, Dahmer.
Oh, that was so creepy. I turned it off.
Yeah. Did you?
I couldn't do it. It was right before bed. I was like, It got to the point where he had 2 human heads in his home, and I was like, no, I'm out.
I'm watching late night stuff, and it's okay.
There's not much to watch out there. We have run out of TV. That's how awful
not much.
it's been.
All right, so let's just talk about now. And by the way, if you want to give Nikki a call or an email and talk about any of these things, about treasuries or these annuities. By the way, one of the annuities, if the market, the S&P 500 does 0.0, makes no money, they will credit you 8%. If the market does 5, they'll credit you 8. If the market does 12, you're going to get 8. But if the market goes down, whatever it is, 30%, you get 0, which is really good when a market that goes down 0. So give Nikki a call if you think that could fit in your portfolio. We also have some that give you liquidity provision, so you can have that liquidity, like you said.
Yeah, we can also help you out with the 401k. I mean, there's plenty of reasons for you to give us a call.
Oh yeah, if especially if you've lost your job and you're rolling a 401k, we can get some things going for you. Let's all right, here we go. Let's talk about the S&P 500 positive and negative years. So since 1926, the S&P 500 has been up 71 times. It's 71 positive years, down 25 years. The average positive year is 21%. The average negative year is 13%. Overall, the market from 1926 has gone up 10.5%. So that's okay. I mean, we expect that. So when we're talking about one of those annuities that where if the market just goes up a fraction, you get 8, that's pretty good.
Absolutely. It
That's
also
strong.
is smoothing out the ride. So you're not experiencing the same volatility that someone is when they're 100% full bore stock market risk.
You leave out the bad days and the bad years. So speaking
you sleep
of
a little easier.
Exactly. So speaking of days, I just want to show you that, if you're going to be involved in the stock market, you really have to look at it longer term, because it really is. I hear people all the time. I hear it. I know you do too. They say, oh, the stock market, that's gambling. Well, it's gambling if you play it for one day. Because if you invest in the S&P 500 since 1937 for one day, you have a 53% chance of making money. It's gambling if it's for 1 month. Because you hold the S&P 500 for 1 month, you have a 62% chance. And I'm going to go on. It's 3 months, 69. We'll go on 1 year. So if you hold the S&P 500, which is a fund, all right, just say you buy the S&P.
Index, yeah.
In 1 year, you have a 77% chance of making money. So let's go on now, 5-year time frame. If you're invested in the market for 5 years, you have a 92% chance of having a positive return. 10 years, it's 97.36.
I mean, I don't know about you. I know you are quite the poker aficionado, but if I had
Let's not get carried away. If I was that well, I'd be on the World Poker Tour, but no, not going to happen.
But if I had a 97% chance of winning every round of poker that I played, yeah, sure. Then that analogy would be equivalent. There's a reason you get chips at a casino.
Okay, but there are folks that come to us that don't have 10 years. They don't have 5 years. So let's look at the 3-year.
We get creative.
Yes. So the 3-year, if you held the stock market for 3 years, you have an 87% chance of making money, and that's really good. However, there is 13% chance that it doesn't work out and you lose money. So we have to look at doing things that could protect your portfolio. And we've been using some of these in these buffered ETFs, and there's a way to work that. And if you've had not great returns, and look, nobody's had great returns. Nobody. But we have ways to maybe protect your portfolio. All right. And not maybe, we do. So let's go to these are the percentage of drawdowns in the S&P 500 during past recessions. So there's a debate out there, and a debate that I think I started, that after we had the 2 negative quarters of GDP and the inverted yield curve since March, which is end of Q1, I thought that, hey, we're probably in a recession already. So my thought would be that we are in a recession in starting Q3.
Yeah.
Probably. Don't know. We won't know that because the NEBR, which is an acronym for the National
Bureau of
Economic Bureau, whatever.
Recessions. I don't know.
They determine this, but they have a really, really good job because they're going to look in their rearview mirror a year from now.
They are the meteorologists of economists.
Yeah, but at least they can be right. So easy for them to be right. Meteorologists are wrong half the time.
Yeah, because they don't get the benefit of looking behind them and seeing what actually happened.
They're going to go back and say, oh, I see all this data. Oh, by the way, we were in a recession in June of 2022. So here we are. Let's go to this year, we're down 25%. The last recession, the market dropped 34%. That was the pandemic, and that was 2 months. Do we think that things are as bad as they were during that time frame?
Is every business that you know completely shut down?
No.
No.
So,
are the amount of people that were dying at the height of the pandemic every single day from COVID-19, is that currently happening? No. So let's take a look at now 08, 09. Oof.
It's 07 through 09. Market was down 56%. We lived through it. That was terrible, but people lost their jobs. People lost their homes. It was a way different animal than what it is today. So this is not 07, 08, 09.
And it's certainly not 2001.
No, and 2001 was 9/11, which is just awful.
On the heels of the .com bust.
I have to tell you, I've said this from day one. I said this I compare to in 1990, 1991, when the Fed raised rates 6 times in 1990 and the 7th in January of 91. I keep saying, this is what I think. And then in 1991, we were down 20%. Today, we're down 25%. I truly believe, Nikki, this to me feels more like that, which it felt like Chinese water torture.
Of course, it's not fun.
It's not.
No, and I understand why people are uneasy and nervous, but again, specifically speaking to the S&P 500, which is indicative of the market, that is the 500 best companies in America. Are you really going to bet against them as far as historically speaking? It's not a bold move. I mean,
No.
You can't tell me that these companies are doing as bad as they were in 2020.
And here's what I love. I see people on Facebook actually talking finances and saying,
That's
oh my
terrifying.
God,
Other than us.
things are worse. They're bad. They're so bad. The world's coming to an end. The sun's in my eyes. I got a pebble in my shoe. Oh my gosh.
The sky is falling.
I got a cramp. Oh, and look, it feels that.
But there is genuine hurt out there. There are layoffs that are happening.
I'm not saying that's not.
No, and I know you aren't. I'm trying to say that it's not as negative and as bad as you're being led to think.
Right.
But that doesn't mean
the
there
media
aren't
doesn't
people
help.
that are hurting.
The media doesn't help. And I know people are hurting, but people were hurting in a great economy.
Yeah, absolutely.
And they're hurting worse probably now because inflation is really taking the cutting out of your income.
Which is why you can't afford to put it under your mattress as far as any cash that you have sitting on the sidelines.
Bingo.
Because if you do, you are, what is it? It's like you're something about spiting your face. Never mind.
Oh, cutting off your nose to spite your face.
Yes.
I like to call it mental masturbation, but okay.
Well, I definitely wasn't going to call it that.
Okay, I know you weren't, but it's cutting your nose off to spite your face.
There we go.
So, yes, and that's what happens. And we had a client come in today and said, what if I just hold on to the money, wait for the market at the bottom? Okay.
Well, if you have a crystal ball, sir, I would really like to talk to you more.
I consider myself pretty good at I'm not going to not picking market bottoms, but maybe a time frame the market is bottoming, and I think that's that time frame.
Yes.
I think we're probably not that much lower. Here's the problem. Guys like Jamie Dimon came out and said on Monday or Tuesday, said the market could go down another 20%.
Because of
It could do
the
anything.
Fed.
Because the Fed. It could do anything. But the Fed all of a sudden sees, I don't know if they're going to see, we'll know more tomorrow. But if they do a 7-handle CPI, meaning 7.99, then we say, okay, well, maybe things are a little bit better.
Maybe. But at the end of the day, too, something also to be reminded of is the fact that it's not because these 500 companies that make up the market are struggling themselves. It's because of the pressure that the Fed is putting on them.
Right. So let's talk about recessions and what happens. So this is the recession drawdowns, meaning the time frame, the percentage of market goes down during recession, the price returns in their subsequent years. So let's just take a look at 2020. We were down almost 34%, and the market was up huge in the next year. We're talking up almost 75%. In 2007, and the reason I say that because each bar represents 1 year, 3 year, 5 years. We're not there yet. That's why it's not there. But on average, let's go to the average first. The average recession, the market goes down 31%. Okay, year after, up 43. These are cumulative. They're not annualized. So 43% year one, then you're all of a sudden up 64%, and in 3 years you're doubled for the most part. Even in the 07, 09, down 56%, and then up huge, 175%. So the markets do appreciate after these times. And that's what I'm telling you. If you go out and sell now, you're making a huge mistake.
Because you're going to sell at the low. You're not going to get back in until it's probably at least
10, 15%
at the high.
Yeah.
And then you're going to ride the down. The volatility is part of the price of admission.
Here's why. If you're scared enough to sell now, you're way too scared to get back in and thinking, oh, maybe it's going to come back down. I know this because I've lived it.
Yeah.
And this is what I do for a living. And I know that I have these feelings and I have these thoughts.
You have feelings?
I do have feelings.
Holy shit.
I mean, I do have feelings.
That's crazy.
I do, I have some.
Every once in a while.
I have a heart. But I do have
we
feelings.
only know that because you had some issues with it.
Yeah, no, because I do things for people.
You do. You're very thoughtful.
But I don't use that term. Thoughtful makes
Maybe
you
not
sound
very, just thoughtful.
Okay. So let's take a look at this. This is a chart. First Trust, thank you very much. Performance of the market before 6 months before a recession, during a recession, and then 1 year, 3 year, 5 years. So before a recession, the market's mixed. I mean, 1990, 91, we were up 10%.
Because you also have to think, there is so much talk prior to the quote-unquote actual
scares the crap out of you.
That just, chicken littles. The skies are falling at that point.
And let's look recently, because in 07, 09, we were down 1.29%.
Everyone was a little bit elated during those times prior, 6 months prior, everyone's
6 months prior. Now, during that, this is the recession time. So the recession started probably in 08, and then it was down during the recession 35%. But when you average it out, 6 months prior to a recession, we're down 2%. So let's just say the market topped out, which we know January 3rd.
Yeah.
6 months prior to that, a recession, second quarter. So we say third quarter it started. That's your June 6 months. We were down 15% by June.
Yeah. Oh.
Okay. And then now you go to the next, during the recession. Usually we're up. So if they say you're going to be up during the recession, if they call, now an EBR is going to say the recession is going to be, we started July of 2020, we're up a little bit. But 1 year after, you average 21. 3 years after, cumulative, 49, 94, 257, 10 years after. That's what I'm talking about. So how long does the recessions last? Well,
forever.
It feels like it. The average recession lasts 13 months. That's right down here. The 2020 lasted 2 months.
A blink of an eye.
07, 08 lasted 18 months. So we're almost there. We're a third of the way there. 1/3 more and we're there. 01, 90. I mean, but again, these are relative. We're about, look at that, 13 months. So you draw a line here. There's only 1, 2, 3, 4, 5, 6 in the history of recessions that have been longer than this.
One of them was the Great Depression.
Yeah, if we were there. So we don't know. And of course, volatility, and we updated this chart. All right, I thank you to First Trust. They did it. Look at all this yellow. There's volatility every year. The market is down almost every year at some point. But then when you look, let's just go back a little bit. Last year was not really super volatile. We were down 5% at the lowest, closed up 27. In 2020, we get down 34%, but closed. The blue number is where it closed. The low number, or the yellow number, actually the bottom below that line is where the peak low was. So down 34, up 16. That's a 50% rebound in that year. In 18, we were down 20%. We rallied year end to end up down 6%. I think we could see something, maybe not down 6%. We're down 25. I think we could see, I've been saying, I thought we could see down 5 to 8% for year end. It wouldn't surprise me.
It wouldn't surprise me. I also think inflation might be a little bit stickier than everyone had hoped. And so while I would love to see us down single digits, which I thought at the beginning of the year, this problem of inflation is because there are too many dollars chasing too few goods.
All right, and let's look at that. This is your U.S. dollar, folks. In 1981, your $1 was worth 91 cents. Doesn't sound great, but by comparison, pretty good. You have, as time went on, inflation kind of eats away your dollar. Your dollar that was worth $1 back in 1980 is now worth 30 cents.
That was in 2021. Can you imagine how awful that looks?
It's worse now. It's worse now. Way worse now. And we know inflation is running rampant. We know that, and that's what the Fed's trying to do. But we probably have hit peak inflation, so we are down a little bit from the peak. Inflation in general, let's go before. All right, let's go before the big run-up in inflation in 2021. On average, we were around, we'll call it 3%, 2.5%, 3%. That's what inflation was prior to the big run-up in inflation.
Yeah.
And if you look at what really has cost you the most, let me go the other way. Televisions, which I love, I have a million of them, down 19%. Airfare up 33%. Natural gas, gasoline, everything up. Food up 11%.
Well, it's a good thing nobody uses airfare, natural gas, gasoline, or food. Man.
No.
Whew.
No, they
You'd
don't.
be in a tough predicament if that were the case.
They don't. So let's talk about now a couple things. So during the pandemic, pandemic. During the hurricane, we hope everybody really survived it okay. And I know
homes weren't flooded.
I know it was
or
a hassle. I know people, even if you didn't get the flooding, you had some damage. It's going to cost you money. We got that, and I really I feel for you because I know we have the same thing. And but let's talk about a couple things that we like
to talk. To reference Winston Churchill, you never want to let a good crisis go to waste. So
that's really good.
There is suffering, but there's opportunity. And I want to also mention, that we're not going out and, investing for schmucks. Like, we're going out investing for the people who are hurting from the hurricane damage, and now that they're having to pay for those repairs. And our clients are the ones that we are then going and taking advantage of the opportunities for while these things happen. So
that being said, this is a stock that on the Wednesday of the hurricane that we bought. We bought quite a large sum. We bought 7 figures worth of Home Depot.
Before we lost power.
Yeah, before we lost power. I had to make sure we get those trades in. And we did this back in the last hurricane. I think it was Irma. And we did really well on it. And so if our clients had liquidity and they had the ability and risk tolerance to own single stocks, I think Home Depot is a great play. So, we buy it around here. And it went up a little bit, down a few days, but it's still up. But we believe owning Home Depot for the next couple quarters, there's going to be a lot of money spent. This was something that was not in Home Depot's estimates.
Right.
As far as earnings.
And who knows
So-
what's going to happen? I mean, I just heard today about another tropical storm that's out there. So these things happen.
The point is, and
And
stocks.
also, I spend way more money now at Home Depot than I ever did doing home improvement
There you go.
bullshit. So, I'm
But
part of it.
stocks move on earnings and or anticipation of earnings. And Home Depot is going to have to say, wow, yes, the hurricane closed us down for a day. But now everybody's having to buy everything.
Right.
We're going to raise our guidance, and that's going to help the stock price.
Yep.
That's I totally
We're
believe
gonna
that.
be doing more in sales.
Yeah. So, I mean, that's one of the ones where we do like, and we had been buying. We still love the buffered ETFs. There's
Those are
one,
fantastic.
there's another buffered, I'm not going to say it's an ETF, but it's another buffered investment that we really like. That's going to give you 30% downside. It's coming out in a couple of weeks. 30% downside and give
Protection.
you about 12 to 15%. It's not set yet. 12 to 15% upside cap.
That's the
crazy.
beautiful thing about the shitty environment we happen to be in.
Yeah, the interest rates are fantastic. So
They're helping us out on one end of the equation that in my 5 years in the business hadn't really been a factor.
And lastly, if you have an annuity, you have a 401k that's been sitting around, especially annuities that sit around and do nothing, things have changed, folks. It is now a very attractive vehicle. So I would recommend you give us a call, talk to Nikki, set time to get in the office. We'll sit down, both of us sit down, talk to you. We'll figure out what your plan is. And we have a CFP here. She can do the financial plan for you. So we do that kind of stuff. We also offer tax services. Jared Bocart does our taxes. And we have a lot going on. The office did move. We are in a little bit bigger space than we were before. And I like it.
Much more beautiful.
I like it. It's really, really nice. So anyway, really
very
appreciate
pleased.
everybody joining us tonight. And we will catch you next Wednesday. If we can help you, give us a call or email Nikki, Nikki, at StockDr.com. We will see you next time around. Thank you.